I've been given the signal. It's 6 o'clock. We're going to call this meeting to order. And we're going to pledge the flag, please.
Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all.
Thank you very much. Nicole, roll call, please.
Director Goel?
Present.
Director Duarte?
Here.
Director Von Heater-Leopold?
Here.
Vice President Govindarao?
Here.
President Halkett?
I'm here. Thank you very much. Item 4, special announcements and activities.
No special announcements this evening.
Wow, be still my heart. Public comment. It's an open meeting. I have no blue cards. Nicole, anything?
No speaker cards.
No speaker cards and nothing online. Yeah, because we don't do that anymore. All right, good.
That's
okay. Agenda management.
No recommended changes.
Okay. Consent calendar. Matters listed under this item are considered routine and will be enacted by one motion in the form listed below. There will be no separate discussion of these items unless requested by a member of the board or the public prior to the time the board votes on the motion. Is there a motion to approve the items under the consent calendar?
Also moved.
I'll second.
I've got a motion in a second. Get that recorded, Doug. I'll call the ball. All in favor?
Aye.
Aye. Any opposed? Any abstentions? Nope. The consent calendar passes 5-0. Board business. Item 8A, receive presentation on investment portfolio.
Good evening, President Halkett, members of the board. In January of 2025, the board authorized an agreement with Chandler Asset Management, Chandler, to actively manage the district's investment portfolio. The transition from in-house staff management to Chandler has now fully been completed, and tonight Chandler representatives are with us to provide an update on the portfolio. So with that, I will turn it over to Ken Spray, our finance director, who will introduce the Chandler team.
Good evening, President Halkett, members of the board. Tonight's presentation is an overview of our investments portfolio as of December 31st, 2025. I have with us our consultants from Chandler Asset Management, Mr. Carlos Oblitas on my right, and Mr. Steve Huntley further over. You may proceed.
Thank you, Ken, and good evening, Mr. President and board. We're happy to be here and delighted to give you an update on the progress and positioning of your portfolio. Carlos and I are going to split the presentation, so I'm going to provide you a brief economic backdrop, so that will give you the context for what Carlos will explain to you as far as the positioning and the performance of the portfolio. And we recognize that not everyone's passion for economics is quite as strong as ours, so I will keep it brief, but try to focus you on what's the most pertinent, and so we'll put it all together at the end, and hopefully you will gain something from this. So I'm not one to set New Year's resolutions, but when New Year's does come around, I like to think about the year in past and review. And when I'm thinking about 2025 in the rearview mirror as far as economics goes, it has been quite a year. So I'm sure we generally have some economic headlines from time to time, but this 2025, this last year, has been substantial. I don't know if you remember, but back in March and April, the markets were really shaken by the introduction of tariffs and trade wars. We then had the passage of the One Big Beautiful Bill, which continued federal deficits. We've now gotten to the point where the national debt has $1 trillion in interest payments every year. There was a downgrading by the last of the rating agencies of the U.S. federal government down to AA. Yet at the same time, we've seen strong GDP numbers. We've seen record highs on some of the equity indexes. Gold is at a record high. there's been all kinds of different things going on. There's also been geopolitical influences, bombing in Iran, the attack on Venezuela, and now whatever it is that's going to happen with Greenland, so on and so forth, right? So there's been a lot of noise out there, but we're happy to report that the progress on your portfolio has been really good. The timing has been great, and working with staff to make sure that we have a policy that makes sense and, of course, is in compliance with government code really gets you on a strong footing so that when we stay disciplined, you can see those results over the long term, but also you're going to be seeing them here in the short term. So I know that there's a lot of slides in this presentation, but I'm not going to go over all of them. I'm going to just highlight just a few. So despite all that noise that was going on, what I really want to focus our time on tonight is understanding a little bit about what the Federal Reserve has done and why that matters to you and to your public funds that you are charged to manage. So the Federal Reserve has actually taken quite a bit of action just the last quarter, but this was kind of a climax to an entire year where they were very patient, maybe not to the favor of the current administration, but they finally took action because what we look at here on this chart on the left is that's the non-farm payrolls. And you'll see in those last few months a substantial decline. Now, part of this is due to a normal annual revision. Those numbers, this happens every year. Excuse me. That annual revision was a revision down of 900,000 jobs. So we didn't lose 900,000 jobs. We just overestimated 900,000 jobs. And so that correction was made at the same time that we got some weak job information, and we had a 43-day government shutdown. So we were all a little obscured on the data on what exactly is happening. We got a negative read. Then we had the laying off of hundreds of thousands of federal government employees. And so it was a little shaky. We weren't sure what was going on. And you can see as a result, the unemployment rate there on the right hand of this page did tick up a little bit. So just to step back just a little bit, the Federal Reserve has two main mandates. And the first one is to manage this, to make sure that the country is fully employed as much as it wants to be. And two is to make sure that inflation doesn't get out of control. So they took action because they saw this weakness in the unemployment, and they made 3 consecutive rate cuts to that overnight borrowing rate, as well as some other things that we'll talk about and that they used in their toolbox in a little bit. So I'm going to skip over 2 pages. And remember, I mentioned that there's 2 main mandates of the Federal Reserve. The first one is to keep the country employed because 70% of the economy is you and I. We're the consumer. We go down the street and we go out to eat. We go to Walmart. We go to Costco. We book cruises. This all makes the economy go. And we're 70% of that economy. So we want to keep 70% of the economy employed because they will stop spending if they don't have jobs. But the other thing that they need to manage is this. Right here on the right, personal consumption expenditures. This is the Federal Reserve's preferred gauge to measure inflation. And you can see their target there right now is an average of 2%. And even though we've come down substantially from where we were in 22, we still never quite got to that 2%. We've been hovering around that closer to 3%. It's actually about 2.7%. And this is because partly due to the impact of tariffs, but there's also some other things going in the economy that could be impacting this. But the problem is that the Federal Reserve doesn't want to stimulate the economy too much because they don't want inflation to go back up. So what I like to do to paint a picture to get people's understanding of what the impact of inflation is just imagine, if you would, you take that graph and you flip it on the x-axis. And now it's a hole, right? That graph, instead of looking like a mountain, it looks like a hole. That's a hole that was dug in your purchasing power. And so we're trying to dig our way out of this hole and get that purchasing power back for those dollars. So these are the 2 things that the Federal Reserve is trying to manage. And in the midst of that, just to give us some kind of idea of what the consumer is thinking and what that looks like in the future, you can see that advanced retail sales are still healthy. And so obviously the consumer is out there and still purchasing things, and making economic activity. But on the right, you can see that consumer confidence is actually a little bit lower and dropping. So generally we're pessimistic about how the future looks, and this involves job prospects, inflation, prices, incomes, all those financial conditions are both current and future, and it's kind of amalgamated into this one metric right here. So it's this interesting dynamic because the consumer is basically thinking that the future doesn't look so great, but we're still continuing to get all those Amazon boxes in our garage, right? So an interesting dynamic that's going on there. I'm going to skip over a couple of these indicators. We can come back to them, but I really want to focus our time on GDP. This is the ultimate measure of what's going on in our economy. And you can see it's actually been surprisingly strong. When we started 2025, the consensus among economic pundits was basically that we could expect a weaker 2025, in that 2024 ended with a GDP growth of about 2.4 or 2.5%. We should expect somewhere around 1.8, 1.9 for 2025. Well, we're on track right now to be just as strong as we were in 24. So surprisingly higher than the consensus. And you can see this is really powered by that top gray bar right there, personal consumption expenditures. That's us. And we had a little bit of a blip in that quarter there with that's labeled March 25. That's when tariffs were announced. So there was a big influx. You can see it in that net exports and imports. That's everyone trying to get goods into the United States before they get taxed, right? And you can see that kind of corrected in the next quarter. So we've got a strong economy, but there's some cracks. There's some weaknesses that we're seeing with jobs. And I talked about the Federal Reserve taking action, and these are the two tools that they use that I want to talk about just a little bit before I hand it off to Carlos to tell you why what everything Steve is saying even matters or makes sense, right? So on the left is the Federal Reserve balance sheet. This is one way that the Federal Reserve makes sure that monetary supply is adequate. It goes into the open market and becomes an actor itself. It buys securities and brings them onto its balance sheet and pushes. It's just like any other transaction. If you bought securities, you would exchange what for it? Cash. But this puts cash out into the system. So you can see that very thin gray bar, that represents the pandemic. And you can see the Federal Reserve went out and they bought $5 trillion worth of securities. So they injected $5 trillion of cash into the system. And since then, you can see that we've been slowly taking those off the balance sheet. Well, that changed in December. So when we talk about taking securities off the balance sheet, we're selling them, we're taking cash out of the system and releasing those securities. That's called quantitative tightening, or as I would put it, you're putting your foot just on the brake, just a little bit. That's quantitative tightening. What happened in December, as of December 1st, you can see that a very, very small blip right there on the right. They took their foot off the brake and they put it on the gas. And this was, again, in relation to that weaker job numbers that came through. In addition to that, you can see on the right, the effective federal funds rate. This is the rate at which banks can borrow money overnight so that they can meet their liquidity requirements set out by the government, but it makes their rate makes borrowing money overnight either less expensive or more expensive. And you can see because they did those 3 cuts, it's getting less expensive. That's a way for them to stimulate the economy again. Again, putting their foot on the gas rather than the brake. So that's nice, Steve. Does that matter? What does that mean for me? Well, what it means for you is that because you're subject to government code restrictions on your investments, you are only invested in fixed income securities. And fixed income securities are roughly charted by this U.S. Treasury yield curve on the right. And you can see on that left-hand side, the very front end of that yield curve, as we call it, has come down substantially. And that's because of those 3 rate cuts. That means your most liquid investments, like in money markets or pooled investments, or like your overnight accounts or checking accounts, those are going to be yielding much less in the future. And we call this the steepening of the curve. The front end is low and the far end is higher. Now, the whole curve has moved down a little bit, but you can see that that's steepening. This is actually going to benefit your portfolio because it's allowing us, when Carlos and I go out and look in the market, we can actually buy higher yielding securities for a longer amount of time. So as they get closer to maturity, they keep that higher coupon payment. But in addition to that, they also go up in value because there's an inverse relationship between rates and the value of the securities that you hold. So your portfolio is now firing, as I like to say, on all cylinders because you're increasing the value of the securities that you hold and your coupon payments are higher. Now, Carlos is going to get into a little bit more on the details of how we've transitioned your portfolio from the existing securities that were there to something more on target with what we're with the benchmark that we're guiding your portfolio towards. But I wanted to pause here and see if you had any questions for either Carlos or I, or if you just want to hear me stop talking, that's fine too.
No, I was going to actually pause you here before we transition. Any questions for our first presenter? I have one.
Yes.
These are macro U.S. level economic data.
Right.
Is there anything specific to our area or California that is different or trends different or is notable?
I think we can go back. It's not a substantial part of the GDP necessarily, but housing is always an interesting story in California, right? Because prices are so elevated, the supply is low, and really recently the cost to borrow has been high. And what I like to tell my wife is that we are never moving because I'm one of those lucky few that has a mortgage at 3%, right? So that's impacting the available supply that's out there. So that certainly has an impact on the economy. As far as anything else in this presentation related specifically to California, California has its own unique budget impacts, as I'm sure you've felt. But right now, I feel like the big news is really federal level things because there, with the budget cuts and the one big beautiful bill and some of that, attempting to make cuts has really impacted local agencies getting grants. There's actually been clawbacks of some appropriations and things like that. So I am grateful to not be a finance director anymore right now. I kudos to your staff over here because it's a tough job, and there's a lot of things that are dynamic, and there's a lot of things that are challenging right now. And when you're serving a public that is facing increased costs and reduced buying power, but you're in a budgetary situation where, you might have to cut costs or you might have to raise rates. That's a really hard sell. And so it really takes some dedication and really some being able to explain very technical things in good terms. So kudos to your team for staying the course on that.
Thank you. All right. Unless we have anything else, let's keep going.
Okay, so let's talk about the portfolio. Before we get into there, and I'm going to hit some very select pages because I want you to get a very good picture. So I want to summarize or re-encapsulate what Steve said. Effectively, we are at what most economists would say are at the end of the business cycle, at the tail end of the business cycle, where the growth is sort of petering out, although the third quarter of the last calendar year was quite strong. We anticipate that things will slow down somewhat, but in this instance, the Federal Reserve, which sets monetary policy, has been lowering rates, as Steve discussed. When those rates fall, it has an impact on your portfolio because your portfolio is a portfolio of debt securities. Bonds are debts. You're lending money. And effectively, that's an income stream. If you lend money out to somebody, you're waiting for those interest payments to come back to you. And you're also waiting for the principal to come back. It comes back in one lump sum. It's not like a mortgage where the debtor pays back a combined principal and interest payment. They're just paying pure interest, and at maturity, whatever the maturity date of the bond is, you get the lump sum of the principal back to you. So while you're waiting for that cash flow stream, other investment opportunities are flying by. And if interest rates in the markets rise, it means that new investors have an option of buying other investments that are yielding or providing more interest income than yours. So when those rates rise, the value of what you're holding and what's due to you goes down as a result of that. And the opposite happens when market rates fall. If market rates are falling, what happens is because you have an income stream due to you, which you basically invested in when rates were higher and you're getting a higher income stream than what the market is offering, it causes your portfolio to go up in value. It's an inverse relationship. Rates rise, the value of your investment falls. Rates fall, the value of your investments rise. Not only that, the impact is, this is why we focus on the economy, because the economy dictates where these interest rates are going to go, and those interest rates dictate what you're going to earn or not earn. So this is why we go into the economics. So having said that, the second impact of those movements in interest rates is that it'll dictate what you're going to be reinvesting into the future. You do have a portfolio of diversified securities with different maturity dates, and the way that they're structured is deliberate. There's a strategy behind that. But as those interest payments come in, let me rephrase that. As you invest into those different maturities, if rates fall, what happens is when you have a maturity in your portfolio, you're going to receive that principal back, and you're receiving interest payments along the way before you receive that principal payment back. When you receive that money, you go back out and reinvest. And if rates are rising, you tend to reinvest into higher yielding securities. So your overall average interest goes up. And of course, the opposite happens if rates are falling and your portfolio is gaining value, as I stated, at least on paper. When you reinvest, you're reinvesting in increasingly lower rates, so your income comes down. Your overall return comprises those two components: fair value appreciation or depreciation, and also interest income. If I put on my hat as a board member, as a policymaker like you tend to think of the income-only part. We call it yield. And the reason you think about that is because those are actual hard dollars. They're greenbacks that can be spent, that go to the budget. They're part of your income, along with rates that you collect and all those things, okay, from ratepayers. So the component, that fair value component, sometimes gets realized with our strategy with a sale before maturity. Sometimes it doesn't. But we give you a full economic picture of what happened, whether we sold something or we didn't sell it and it just went up or down in value. When I show you the return numbers, it's going to include both of those components. So you get a holistic picture. The reason that's important is because your staff, your finance staff, per accounting rules, books that change in fair value on paper in your annual financial report, your year-end report. If you're familiar with GASB, Governmental Accounting Standards Board, it's GASB 31. They'll look at all the interest income you earned for the year, and they'll either augment it or reduce it by the amount of change in fair value on paper. So all of it flows through your financial statements. All of it impacts your financial position. If you're issuing debt, the debt rate, the rating agencies will look at that position. They'll look at how you're handling it all. So that all of that is important. And the strategy that we have worked out and collaborated with your staff to implement addresses all of these factors, not just the interest income, but also the change in fair value. Everybody follow me so far?
Makes sense. So how often do we mark to market?
In our portfolio every day, but you see it in your statements on a monthly basis.
Monthly? Okay.
Yes.
So our monthly reports have it marked to market?
That's correct, yeah.
Thank you.
So
The treasurer's report that's also on the agenda is at monthly value.
I saw it, yeah.
So, all right, so let's talk about that portfolio. It is a portfolio of debt securities. And again, what we're trying to achieve is increase the fair value in an up market, or at least protect it in a down market. We can't control where markets go, but we can control how we structure the portfolio to guard against a bad market. And then, of course, we're trying to capture as high as possible interest income wherever we do that. The way that we do that is generally when rates are falling, you want your average maturity of the entire. When I look at all the maturities in the portfolio and I average those maturities on a weighted average basis, weighting it by market value, when rates are falling, you want to be as long as you can be, because it means that your maturities come later. You're waiting for the money to mature, and as rates fall, you are not reinvesting as quickly in a falling rate market. So you're protecting your income. You're holding on to what you have for longer. When rates are rising, you're trying to do the opposite. You're trying to get as short as possible, because as rates rise, you have more maturities coming due faster, which you can then redeploy in higher yields as market rates rise. Do you see the problem with that? The problem is, how do I know when rates are going to rise? How do I know when rates are going to fall? How do I know to what degree they're going to rise or fall? How do I know when they're going to start to rise and stop to fall? How do I know in what maturity ranges that's going to happen? Because different maturity rates don't move lockstep. Okay, we don't know. Those are a lot of unknowns. Now, we've been doing this for a long time. Steve and I have been in this industry for many, many years, decades. I've been at this, is my 31st year at this. We're pretty good at knowing, kind of guessing where rates are going to go. But this is a safety and liquidity portfolio mandated by code. We don't make those kinds of bets. That's not how it works. So what we do is we look at how building a portfolio with a weighted average maturity, and to be more specific, we look at a duration. It's a similar number. It's a risk measure for us. But we look at building a portfolio with a specific duration, and we look at shorter durations and longer durations. The longer the duration, the less maturity is coming due. And what happens is we work through seeing what that might look like in different rate environments, and we pick a target. And that process was a benchmark study that your staff collaborated with us on to decide how we would structure this based on what kind of cash needs you had in the portfolio. So staff had a hand in all of this, taking into account your financial position and your financial needs. So we pick a target and we stay there. We can get a little bit longer than that target. We can get a little bit shorter than that target. The target comes from an industry benchmark, basically. It's the target duration. So regardless of whether rates are rising or falling, we kind of stay within that target, within a range of that target. And we do that because we try to get as long as we can with the amount of volatility that target brings that you're comfortable with, and also the kind of maturities that you need coming into the portfolio. That's generally the approach. That strategy was set with staff, and the strategy was to keep the investments primarily between 1 and 5 years. Sometimes we have a little bit longer. Your policy does allow that, and code allows that as well in certain circumstances. Sometimes we buy maturities a little bit shorter, but they average mostly between 1 and 5 years. And when I average the duration out, it works out to be somewhere around 2.5 years. So that's been the strategy, is to move that portfolio somewhere between 2.5 years, maintain maturities on the whole mainly between 1 and 5 years, and then diversify the different types of bonds that you can buy, because there are different bond market sectors that are allowed that you are allowed to purchase under California government code. That's been the strategy. The situation that we inherited was that the portfolio was quite long. So this is before we were brought on board specifically to address this. The portfolio had been positioned longer at a period when rates were at the rock bottom, actually historically bottom. So it means that you locked into yields that were like sub 1%, in some instances sub 0.5%, for multiple years. And as interest rates rose in the markets after the pandemic, the value of those investments decreased precipitously. It was you had a huge unrealized loss in the portfolio, which was flowing through your financial statements, and it was making the portfolio look like you were earning very little on these investments. And that's one of the things that staff brought us on board to start addressing. So we addressed it by implementing this strategy, which staff had a voice in implementing and selecting and building out. And we addressed it with a strategy where we would actively manage the portfolio, meaning we don't just buy the bond and hold it and kind of wait for the income to come in or the maturity and then go back in and do it again. It means that we're monitoring the investments daily, every single day. And if there is an opportunity to reposition the portfolio so that we improve credit quality, improve liquidity, move it back to our duration target, or lock in a gain, or maybe even take a slight loss for higher income into the future, we do that. So we do have sales before maturity. This is an actively managed portfolio. Unlike the stock markets, where it's very difficult to beat the markets because the stock markets are very, very efficient, so it's very hard to actively manage. That's why people index. In the bond markets, it's different. It's a very inefficient market, and active management actually adds value over time. This is a mouthful, but I want you to have the backdrop of what we tried to do here. So, having said that, I want to hit some slides and then we'll take some questions. If we turn to page 15, it's an overview of what the portfolio objectives are. Again, we are rooted in what's mandated by California government code. That is safety first, followed by liquidity, and then followed by return. Your money has to be safe. It has to be available when you need it, or readily available if we need to cash out of it. And then after that, then we have to position to earn a return. And those objectives are listed under code in order. The next 3 pages I won't go into, but they basically are a summary of your investment policy and the portfolio compared to your investment policy to see whether you are compliant with your policy and with California government code. This is an important part of the service we provide, because this allows you as policymakers to demonstrate to the general public that you follow the law, and that you have a portfolio that is compliant with code, and a portfolio an investment policy that is compliant with California government code. And if we turn to page 19, if we look at the portfolio, the column that stands in the very, very middle, that's where the portfolio stands today. And I'm going to go over that right now. Right now, the average maturity of the portfolio is 2.91 years. It's the middle column, but the duration is what counts. The duration is different. It's, if I want to get really technical, it's the present value of the future cash flows weighted for time. It's a function. It's a calculus function. It tells me how sensitive this portfolio is. The market value is how sensitive the market value is for a given interest rate shift. But the strategy, I said, was to be somewhere around 2.5. Well, the strategy is, if you look to the column to the left, that is the duration of the benchmark. We use a 1 to 5 year Treasury and agency benchmark, which has the universe of Treasuries between 1 and 5 years and a sampling of federal agency securities. And the duration of that benchmark is 2.47. I want you to notice that the duration is 2.56 years. And we've positioned it deliberately longer because when we started working with you, we were already in a downward rate environment, and we had anticipated that that downward rate environment would continue, and that's exactly what happened. And the fact that you are longer than the benchmark helped you outperform the benchmark, which I'm going to show you in just in a few minutes, okay? So that is the strategy. 3 months prior, we were slightly longer. When we inherited this portfolio back in March of 2025, before we started positioning it, the duration of the portfolio was more like 2.49. So we've increased the duration, and that's one of the first things that we did. The second thing that I want to highlight is that currently your yield to maturity, that is an indication of the interest income that you are due to earn on this portfolio into the future on an annualized basis, assuming nothing changes in the portfolio. So the way you're structured now, if we don't change anything else and we reinvest incoming interest payments at the same rate, you're due to earn a 3.37%. When we inherited this portfolio back in March of 2025, that yield to maturity was 197. So you've moved up significantly in the interest income. You've increased the interest income in this portfolio quite well. If you think of driving a car, if I'm driving 60 miles an hour, well, in an hour, I should cover 60 miles. What this says is, if I'm getting a yield to maturity of 337, it means that in a year, I will have earned 3.37 in interest income only. So that's a positive thing. You're moving ahead on the interest income machine. The market yield is that same purchase yield above had you purchased this entire portfolio on the date of this report. Why do I show it there? The reason I show it there is because if it tells me what I would get for your portfolio on the date of this report, if I were to receive new money to invest, or if I were to receive a maturity from the existing portfolio and reinvest it, and make it look like this strategy, like this portfolio, that market yield infers a reinvestment rate. Right now it's 3.74. 3 months ago it was 3.76. When we started, that reinvestment was 4.18. It shows you how much rates have fallen in the market. So we've been in a downward rate environment, and that's what that shows you. The average quality hasn't changed very much. It's still pretty strong. We're managing about $189 million for you overall. That is not the entirety of the investment program. There are other investments that staff maintains, primarily in the state pool local agency investment fund, and of course your bank accounts, and those funds are used for day-to-day expenditures, and they're kept very, very liquid in a very liquid pool deliberately. That's just to make sure that you have cash in the bank to pay your bills. If you
Hey,
look,
just a quick question there. If you can
yes.
go back to that slide. So, you're talking about the average purchase yield, you're talking about the average market yield. So I guess my question would be is, so on that day, 12/31, the average market yield was 3.74, correct? So why not then reinvest that portfolio that's actually, unless there's a reason why we can't or we're locked in, why not just take that and put it in that, on that 1231, so we get the rate at that time versus all those older investments that are not getting the yield that we would expect it to get during that time period. Does that make sense?
Yes, to a degree, we have done exactly that through sales, strategic, or I should say tactical sales before maturity. Now, we haven't done it wholesale in the entire portfolio because you had several securities that were at a significant loss, and those whether we realize them or not, those unrealized losses would become realized losses, which would start eating at your budget part of the return, of the income part of the return. Having said that, we have done that to a degree, and we continue to do that. One of the things, remember that I said that when rates fall, the values rise?
Mhm.
Those losses have been diminishing naturally for two reasons. Number one, because rates are falling, and as rates fall, the value goes up. So if it's in a hole, it's less of a hole. The second reason, of course, is as securities get closer to their maturity date, the market value of the security converges or starts to converge with the par value, which is the principal value, the face value of the bond. So to a degree, we have done that, but we do that tactically, and we do that within the scope of the strategy, because if we started selling wholesale, it would mean that we'd have to go back into the market. It would mean that we'd have to rebuild that duration. It would mean that the term structure of the portfolio might look different. And the opportunities are, we're very selective in what we're buying. We're not just buying wholesale a yield. We're buying in specific sectors. We want to have certain holdings in specific sectors. We want to have holdings in specific maturities. How we structure those maturities and sectors is very tactical. It's thought out. It's not random. So we have done that, but we don't just do it wholesale. This is a safety liquidity portfolio, and the risk management approach is to do incremental changes, little by little, always, because this is money that you rely on. If we make a move that's drastic and market rates move against us, then you're going to be in the hole, and it's going to take you years to get out of. And again, safety liquidity, we don't want to put you in that position.
Okay. All right. Thank you.
And it's pretty apparent. I mean, the spread between the purchase yield and the market yield has shrunk a lot since you guys took it over. I mean, it's just right there on the chart.
Right. Your yield has come up
Yep.
significantly, but rates have fallen, and rates are anticipated to continue to fall through at least the first half of this year. We can talk more about that in a minute.
So was the result result that the rates have fallen, or was it the result of, I guess what I'm looking at, if I was to allocate what percentage would be credited to the rates falling versus you actively managing and making some changes? Does that make sense? Because
Yes.
obviously there's two factors there. So which one is right now outweighing the other? I'm just curious.
So there are two, I'm going to give you two answers because there's two ways to apply the very question you asked. On the return, the fair value appreciation has primarily been both reasons, because rates have fallen and because we've positioned you longer to go up in value more when rates did fall. And that was deliberate. So there's that answer. The yield itself, however, is a function of what we're able to capture. And the reason it went up so much, 3 months ago it was 248. Now it's 337. And back in March when we started, it was 197.
Mm-hmm.
The reason for that is because when we've received maturities or we've sold something at a gain or a slight loss, we've been able to reinvest in higher yielding securities than what you already have in the portfolio. And we've done that by diversifying the portfolio greatly. One of the first things we did was work with your staff once more to revamp and update your investment policy to allow asset classes that are allowed under California government code that you've never touched, that give you a yield premium. So you were reinvesting into yield advantage securities with a higher yield than what you were getting before, even though rates were falling in the market. And that's active management. That was through our decision.
Okay, great. Thank you.
Okay.
Thank you.
The ABS is a big, and the increase in corporate securities, and I'm going to show that in the next page.
Great.
In fact, if we look at the next page, you can see what I mean. So this is the makeup of the portfolio. The bulk of the portfolio is still U.S. Treasury securities. Again, I emphasize, this is a safety liquidity portfolio. Bonds from the United States government still are considered the safest investment by investors, the most liquid. If we had an emergency, a a national emergency tomorrow, and we needed to start selling securities out of this portfolio, that is the most liquid asset class in the portfolio. Generally, we're going to find a counterparty to be able to buy it from us. It's high, despite all the geopolitical posturing that you're seeing, they're still highly sought after, very liquid investments. What we've done is, I just want to show you, treasuries currently make up a little bit less than a third of the portfolio, about 31.4, so 31 and 2/5. When we inherited this portfolio, it made up about 24% of the portfolio. We've increased treasuries to increase liquidity. And some of those treasuries were longer to pick up those higher yields in the longer maturity ranges. The corporate securities, those are allowed by code. You're allowed to buy down to single A or higher. The bottom of investment grade, meaning that the most highly rated corporate bonds are triple B or higher. You're not allowed to go down to triple B. You can go down to single A, double A, triple A. You can go down to single A. So we increased that. You used to have about 14.8, almost 15%. We increased that to almost 24%, 23.9. That right there added significant yield, and we mitigate, because that's additional credit risk. This is not the United States. These aren't United States government securities. These are securities from private, or I should say public corporations, publicly traded corporations. So we mitigate that risk through a robust risk management process that encompasses robust credit analysis. We have analysts who are looking at these issuers and looking at their financials and tearing them apart and trying to make a determination as to whether we're going to get paid back or not. That's part of it. The other part of it is that we are slicing and dicing our exposure by name to tiny little slices, and I can show you that in the next page. So we don't want too much of our eggs in a single basket. We want a bunch of baskets and a bunch of eggs. So we increased that, and that helped increase your yield. The federal agency securities, these are federal agencies of the United States government or government-sponsored enterprises. You know them as Fannie Mae and Freddie Mac. You used to hold 38%, almost 2/5 of your portfolio were in federal agencies. We've basically been, when we have divested, it's generally been those, and we've not been reinvesting in these because even though they're considered almost, not quite, but almost as safe as treasuries, generally, you used to get paid a yield premium above a treasury because they're not a treasury. That yield premium has shrunk to almost nothing. We just don't, they're very expensive. We don't get paid for them. And because of that, we'd rather have the treasury, which is much more liquid, and give up 1 or 2 basis points. So on a risk-adjusted basis, we'd rather have the liquidity. So we've been reducing those. There's just not a lot of value there, relative value. The muni bonds, unless you're buying large structures at the state level, a UC, University of California bond, a state of California bond, or the states of other state treasuries which are in good standing or good credit quality. Unless you're buying something large, of a large issuance, billion plus, these tend to be very small and as a result very illiquid. So we've been reducing that exposure. Currently you're at 17.8%. You used to have a little bit over 21%. We're letting those roll off as much as possible because they're just not as liquid.
No,
But on the flips, oh, go ahead.
and besides, the double tax-free treatment doesn't do us any good.
Not really. Because you can issue municipal, just like you can issue at a tax-exempt rate, which lowers the borrowing cost, which lowers the yield to the investor.
Exactly.
There are times because credit quality for municipal issuers tend to be high. There's just not a lot of investors buying it other than retail. So it's, you're not a retail investor. You have a sizable, almost a $200 million portfolio.
Yeah, it's more of a retail thing.
Yeah, we can't buy little $250,000 tranches. We're buying bigger, so round lots so that they're liquid. So we'd rather have the treasury in most instances. ABS is a new type of asset class to you. ABS stands for asset-backed securities. Think of a pool of debt, a pool of receivables, meaning you have a pool of people who owe money into that pool, and you are buying the rights to those payments. Let me give you an example. Back in the early 90s, David Bowie, you remember David Bowie, the singer, he had records where he was due to receive royalties into the future. What did he do? He didn't want to wait for those payments to come in over 10, 15, 20 years. He worked with some investment bankers to put a value on that income stream and borrow that cash up front. And then the investors that loaned him that money would get paid back from those future royalty payments. He securitized that future income stream. Now, those are David Bowie bonds. We do not buy any David Bowie bonds in this portfolio. That's not in here. But we're buying credit card structures. We're buying auto loans and auto leases that are structured in a way that are very advantageous to you. So this is a pool of very highly rated FICO score auto loans where people are paying down their debt. And there's a yield premium that comes to you from that, and you'd recognize a lot of the names: BMW, securitized assets, Honda Auto Owners Trust, things like that. So California Government Code allows you to buy up to 20%. We wouldn't hold 20%. We may hold as much as 8 to 10%. Currently, you're less than 3.5%. But those bring a yield advantage, and that has helped incrementally move the yield up. So you held none before. Currently, you hold 3.42. And then the negotiable CDs, there's not as much value. You have to buy them in a certain size to make sense. You held a little bit less than 2%. Currently, you hold 0.6, almost 0.7%. So that restructuring and the allocations to the different asset classes, the way that it's been allocated, that's deliberate. There's a strategy behind that, and it's based on analysis that our team has done to be able to structure it that way. And it's not just for the current yield that you're getting, but also for what we anticipate the future markets are going to do. If we turn to the next page, I won't spend too much time, but you do. These are all the issuers in your portfolio and how much they make up in your portfolio. So anything that's a governmental security, so treasuries, agencies, those are going to be sizable. But when you start getting if you just look at the first security that is a non-U.S. government or government-sponsored enterprise is the state of Ohio, 2.65. We're going to let that reduce. That's a little bit high. We don't like to have that much. That'll eventually get chopped down. The Procter & Gamble, I think we inherited. The Stanford, and which is considered basically a corporate bond, and those are positions. We don't buy positions that high. What I want you to notice is the sub 1% positions. We have a 5% per issuer limit in the policy that we crafted with staff's agreement and help, and that's the limit, 5% per issuer in your policy. Functionally, we buy less than 2%. And if you notice, some of these issues, look at the Wells Fargo bond, it's like 0.13%. Like I said, not all our eggs in one basket. We want to spread this out amongst high credit quality issuers. Let's skip the next page. The credit quality story isn't as big, but I just want you to look at this. This is what the term structure. So these are the maturities in your portfolio based on it's a distribution of the duration. It's very similar to the maturity, and the percentage that you hold in each maturity category between 1 and 3 months, 3 to 6 months, 6 months to a year, 1 to 2, 2 to 3, 3 to 4, 4 to 5, and you can go out to 7 years, even 5 to 7 years. You're in the green. Your benchmark is in the gray, and how we position this versus your benchmark can impact how we do versus the risk measuring and performance measuring benchmark that you have. It's that 1 to 5 year Treasury and agency benchmark that I mentioned earlier. The way we structure these is deliberate, okay? But I want you to kind of note what this portfolio looked like before we started working with it. Back in March of 2025, in the 3 to 4 year space, you held about less than 11% between 3 and 4 years. You currently hold about 35%. In the 4 to 5 year space, you used to hold somewhere like 27, almost 28% of your entire portfolio. That's now been knocked down to 9.3. And you held no securities beyond 5 years, between 5 and 7, which you're allowed to do under code and your policy. You now have 2.7. You held none before. In the 1 to 2 year space, you currently hold 9.6. You used to hold 21.81. How we structure this can make an impact on the risk and the return of the portfolio, and we've rejiggered it to match what we think is going to happen with the term structure of interest rates. And if we go to the next page, and I'm going to start wrapping up here, you can look at the returns. This is a total return. It means that it includes interest income as well as fair value appreciation, whether we realized it with a sale before maturity or not. So whether we took a gain or a loss, or even if it was a gain or loss on paper because of market value movement. For the last, since we haven't been quite working with you for a year, we started counting April 1st of 2025. So that's all of April, May, June, July, August, September, October, November, December. So that's 9 months of management under our belt. That return for those 9 months was 396. It's a since inception number all the way to the right. 396 for those 9 months versus the benchmark of 366. Now, I don't know about you. I don't think in 9-month terms. I don't know anyone that does. We think in annual terms. So you earned into the past over the last 9 months 396. But if I convert that into an annual equivalent, taking compounding into effect, that equates. You didn't earn this, but the annual equivalent of that is 529. And I would say that about 2/3 of that 529 came from interest income, and about 1/3 of it came from fair value appreciation. So you've had a good run to start with. You've diminished your significant unrealized loss in your financial statements. That will flow through. This was a deliberate move. Your finance staff immediately identified that as an issue from an accounting standpoint that they wanted to address. You've increased your interest income in a downward market, in a downward rate market. You've diversified your portfolio beyond what you've done in the past. And you've positioned the portfolio to try and capture whatever's happening into the coming year, which we think is going to be lower rates. So you've protected your income stream into the portfolio. You've had a pretty good run. It won't always look this good, at least while we're managing from a return standpoint, because we're subject to market forces like everybody else. But from a structure standpoint, from a risk management standpoint, from a safety standpoint, it's a pretty solid portfolio. We're using all the tools to make it the way it is, and it is performing as designed, safety, liquidity. So you've had a good run. We're quite proud of the collaboration to make this happen. It meant collaboration with staff to rebuild your investment policy, collaboration with staff to address that unrealized loss deficit that you had so that we don't take shocks into the portfolio, and collaboration with staff to implement a strategy that's going to serve you over the long run. I'm going to stop there. The following page, maybe I'll end with that page. That's a history of your yield. That was that forward-looking number. There's that 197 on the far left. You're at 337 where it is on the far right. That's that income into the future. You've done well here. I'll stop there and take any questions you may have.
Okay, that was a lot. Question.
And now you're drinking water from a fire hose.
Yeah, I'm almost done here. All right, I'll start on my left. Georgine, anything? Question?
I don't have any questions.
Dinesh?
No.
So you take some notes?
No, yeah, no. I mean, I think I asked most of my questions that we were going through. Just a quick one, and I, if you could just remind me on a perspective of fee structure here, is it based on the total value, the percentage of the total value of the portfolio, total value of the gain, or is it based on the transactions or the transaction fees?
It's strictly based. So we're paid. What are we? We're like 6 basis points average. Like a little bit over 6 basis points. 0.06% of the market value of the portfolio annually.
Got it. Okay.
So it's not transactions based.
Okay.
It's not performance based. In fact, we eschew performance based compensation, because in a safety liquidity portfolio, we believe it incents us to chase yield and take more risk, and we don't think that's appropriate.
Okay.
So it's just based on the assets under management. It's the annual equivalent of 6 basis points. You know, we look at the average balance of the month, and we apply the percentage and take 1/12 of that.
Yeah. Okay.
Every month.
Okay. Great. Thank you. That's all.
And to clarify, you asked a really important question. Most people don't ask that. The returns you have are gross of the fee. So when I say a 529, you can reduce that by 6 basis points. So call it a 523.
I see.
So
Okay.
you answered my question already. Go ahead.
That's all. That's all. Thank you.
Ed?
Being an engineer, I never took, but I think 2 economics classes. I just appreciate your passion for your craft. An excellent presentation. I think I've learned more than when I came in here, but I still haven't grasped it all. But excellent job. Where did we find
We love
these
what we
guys?
do.
Arun?
Well, I thought I was the only engineer that didn't understand this, but okay, now I feel bad. But I really enjoyed your presentation, and I normally didn't have the stomach for this. So good job. I really like the fact that we brought you guys on board, and the indicators are showing that it was a smart choice. Now, hopefully, like if this market goes the opposite way, that we are balanced and at least not diving down too far. So, thank you for that. And I am looking at all the transactions you have. You guys are actively managing it, and I'm seeing the maturity and the movements and the percentages and everything going on. So, good job. Thank you for that, and keep us safe.
Thank you. Well done. Yep. Well done. Well presented. Finance can be a little hard for people. Is there any concern? I know ABS is a small, it's like 3%. We seem to be a little concentrated in the auto sector in ABS. And I know that auto loan default rates are rising pretty significantly, right now. I see BMW and stuff, and so is the idea that you have the K-shaped economy, the BMW owners aren't going to have as much trouble as the Yugo owners?
And I'm really glad that you mentioned the K-shaped economy, because that is a very real thing. It's always been with us, but people are really starting to pay attention to that, because that's now becoming the divergence between those two components of society are really becoming wide. If you're not familiar with what the director is referencing, is that we're having an economy where a certain portion of the population is doing this economically, while another sector is kind of doing this, and that's because if you had assets as we've gone over the last 10 years, those assets like a 401k, deferred comp,
Like
a
NVIDIA
home,
stock.
exactly. You've done well,
Yeah.
and if you're younger and haven't had time to accumulate assets or don't have a down payment for a house, well, you're not faring as well, because everything's getting more expensive, and then there's a divergence, and it's very pronounced. But having said that, that might be part of it, but realistically, the real reason why we buy these structures is when we look at these structures, it's a little bit convoluted, and I think the engineers in you, I hopefully will understand it. So when you're buying an asset-backed security, there's some financial engineering going on in there. It's a pool of debt that people owe on their cars. And what those structures do is they do several things to add what we call credit enhancements. So the first thing that happens is the sponsor of that program, of that debt, of that ABS security, will divide up the rights to income streams by categories. Okay, so when you think about it, some of us, we make our minimum payment for our car, just like we might for our home. Other people pay extra because they want to get out of that faster and not have as large a bill, an interest expense bill at the end of the loan. So you pay a little extra. So eventually, some of those debts are going to pay down faster, which means that the average life of the whole pool gets shorter. So what they do is they structure the rights to those income streams by category, and those categories are called tranches. So they'll build a tranche that has the rights to the first prepayments, and then those prepayments cascade to the next tranche, and to the next tranche, and to the next tranche. So we're buying the top tranches. Obviously, if you think about it from a value perspective, the longer you are sitting around waiting for your money, the more risk you're taking on. So those lower tranches get paid more yield. The higher tranches get paid a little bit less yield, but there's more safety because there's more money coming in to cover them. So that is that. So we're looking at the top tranches is what we're doing. That's the first thing. The second thing is these structures will build in place. There will be loans that will underperform, meaning people will be late on their loan payment or even default. Some of the credit enhancements that these structures will have is when they go and borrow in the capital markets, when they issue that bond that you bought, okay, that bond, the amount they borrowed is over collateralized. So I'll give you an example. If it's these things are huge, hundreds of millions of dollars. But let's say it's $1 million structure. Maybe they borrow on 900,000 of it, but there's $1 million of assets worth in the pool. So there's more assets in the pool, more people paying down their debt than what they borrowed out on that debt is backing, that those receivables are backing. So there's more assets than what they owe is what it is. That's another credit enhancement. Another credit enhancement they might take is they might put in place in combination with the over collateralization is they might set up credit facilities with a bank to cover a certain amount of defaults. And then, of course, they structure out and model what those defaults look like. Now, if you think back to the global financial crisis of 2008,
That's where I was headed.
the asset-backed market did not experience any problems.
The
The
mortgage-backed
problems,
market.
the problems were in the mortgage-backed market, and not all mortgages.
But a mortgage
really,
is an asset. I mean,
it's an asset, and it's a receivable, and there's a chance it doesn't get paid down. There's always that risk. So with the global financial crisis, it was really related to subprime. So we're not buying anything that's subprime in here.
you can stop there. That's fine. All right, I have one more. Sorry, it's finance. I like that. Ken, if you needed the $10 million tomorrow to solve a problem, given the portfolio and what we have on, I mean, so where do you get it?
What am I getting?
Where will you get it?
Yeah, where do you get it?
Is the question, where will you get it? If
Yeah,
you need
where?
the money, where?
Yeah,
Where-
so do you have
where are
to
you
tap
gonna
into
source
the
it?
investment pool, or do you have to? I mean, $10 million.
I think I would put it in the investment pool because these people have done just a terrific job.
No.
with this investment.
You need $10 million to
Right.
spend tomorrow.
We have an unexpected expenditure of $10 million. President Halkett's asking, where would we get the funding?
Well, it would be you'd have to do an assessment. We already have a large amount of capacity charges on our books, and so you could either do a pay-as-you-go type of an analysis, or you could look at some sort of a debt issue, and but those would be the two ways to go.
Sorry,
And we
I'm not being clear. You need $10 million of cash tomorrow. Do you call these guys and they have to sell some stuff, or do we have it on hand? Or I'm pulling a number out of my butt, but you know what I mean.
That's an unrealistic situation.
No, not really.
I'm
Somebody
actually going to
tomorrow.
have T. Lucera answer it because she just put together the investment report.
Yeah, we actually have 26
Leif and
million
Camp.
in in Leif and 56 million in Camp.
Camp.
So
We go to
did
Leif
a-
first
yeah.
and
Exactly.
sell anything off. That's all.
yes, we have enough money to
Oh, I see what you're
to
saying.
withdraw immediately. Yes.
So anytime we're tapping these funds, it's going to be planned.
But the Leif, for example, I think is what is that still getting? 440 or something like that?
No, that's come down.
Yeah.
Is it lower? Is it sub 4?
It's way sub 4. Yeah.
Okay.
It's okay. I'm taking this in the weeds. I just want to make sure that we have enough liquidity to handle something.
do.
If it's helpful to you, so typically what would happen is most local governments would tap local agency investment fund, LAIF, or their bank account, but sometimes to build that cushion, they might plan and work with us to do that. To give you an example, if we were to sell, so now you're actually sitting on an unrealized gain in this portfolio. Some pieces are at a loss, some pieces are at an unrealized loss, some of them at an unrealized gain. But to give you an idea of your 189 million that we manage on your behalf, right now on an aggregate basis, you're sitting on about $187,000 of gains. What am I trying to say with that? What I'm trying to say is that if Ken were to decide, well, we need cash and we need to replenish what we just took out of LAIF to pay that $10 million, if he had to come to us, we'd probably be generating that at a gain.
There you go. Thank you very much. I think I've given everybody a chance. Anybody want a second bite at the apple? I think we're okay. These gentlemen probably want to go home.
I did want to congratulate and thank our investment, consultants here for doing a terrific job with these investments. As Carlos just mentioned, the portfolio at inception, when they first took over the contract, was at a significant decline, and Carlos just mentioned that now it's at a gain, which means that all of that, decline has all been eliminated. So I just think that's terrific. And thank you for your. It has to be hard work, thinking through all these calculations with all these changes and investments and things. And I realize it's a team effort on your end, but nonetheless, it still is a lot of work, a lot of analysis.
Yep.
And so,
all right, I get the last word. Thank you very, very much. It's been a great first 9 months. We look forward to working with you for a long time in the future. Hopefully our questions weren't too goofy.
Not at all, Director. Thank you, and thank you to your staff. It's been fantastic collaborating with them. They've been very proactive through this whole process, and they're very much a part of this.
All right. Well, Well done. That was very, very informative. No action, right?
Action.
So there's no action. So we're going to move on, and there's no obligation. Go. All right. 8B. We're going to actually wait 1 second. We're going to adopt a revised investment policy, rescind resolution number 725, and reaffirm authority delegation to Treasury to invest district funds.
There was a small change to the California Government Code on commercial paper, and this revision to the investment policy was simply to keep up with the California Government Code.
Got it.
And so,
It looked pretty trivial. I mean,
yes,
there's like
very
4 red
minor.
lines on the whole thing. Right?
Very
Got it.
minor.
Do I have a motion?
Also,
Any questions? Sorry to preempt, but all right. Do I
I'll
have a
move.
motion. I got a motion there
And a second.
and a second. All in favor?
wait.
Public comment?
Oh, yeah.
Okay, public.
No
Anyone want
public
to comment? No. All right, no blue cards. Here we go.
Blue cards.
All right. All in favor?
Aye.
Aye.
Passes 5-0. Thank you very much, gentlemen.
Thank you.
All right, 8C. Wait for the change of seats here. We got the tools moved. Are we ready, Jen? All right. Authorize negotiation and execution of a memorandum of agreement to cooperate on the development of a long-term seasonal wastewater diversion agreement between Central Contra Costa County Sanitation District, Central San, DSRSD East Bay Mud Recycled Water Authority, DERWA, East Bay Municipal Utility District, East Bay Mud, and DSRSD. That was a lot of work. We're going to receive our presentation now.
Good evening, President Halkett, board members. This evening, staff is asking the board for authorization to execute a memorandum of agreement, or MOA, to cooperate on the development of a long-term diversion agreement with Central San. The board may recall that over a year ago, we started discussions with Central San, DERWA, and East Bay Mud on a long-term diversion agreement. But through these discussions, staff from all of our agencies identified the need to complete certain technical studies that will inform the negotiations on this long-term agreement. So we have now pivoted to a memorandum of agreement. This is intended to be an interim arrangement to allow us some time to complete these technical studies and also provide for Central San to allow DERWA use of the existing diversion facilities while we complete the studies and negotiate the long-term agreement. So this evening, I'll give some brief background on the MOA and cover some key terms. So just a little bit of the refresher on DERWA and our efforts to secure supplemental supplies. Over 30 years ago, DERWA and East Bay Mud formed the partnership that we refer to as DERWA. And then 11 years later, after construction of the recycled water treatment plant and the transmission backbone, we began deliveries. In 2015, DERWA added the city of Pleasanton as a customer. This program has been very successful. We've connected numerous customers, and in 2018-2019, DERWA actually began projecting that we would have supply limitations during the summertime. And because of this, DERWA's board requested the member agencies, East Bay Mud and DSRSD, to implement a moratorium on new recycled water customers in 2019. And this limitation in supply is also due largely to what we refer to as the unintended consequences or unanticipated consequences of conservation. As customers have become more efficient with water use, they're using less water, which equates to less flow to our wastewater treatment plant and thereby less supply for our recycled water program. So that same year, the DERWA board executed an agreement with Central San to build a temporary diversion facility to divert a portion of Central San's wastewater to DSRSD's system, and that project was completed in 2021, and we did operate it in the summer of 2021. It is the only year that this project is operated because since that time, the recycled water demands have been lower, and it hasn't made it necessary to operate that facility. In 2022, DERWA, EBMUD, and DSRSD executed an interim supply agreement to formalize the connection moratorium and also to commit to focusing on looking at near-term and long-term strategies for increasing recycled water supply. And then in 2024, DERWA did complete a supply management plan, looked at a broad range of options, and identified a long-term partnership with Central San as the most feasible option. Also in that year, the Regional Water Board adopted the third nutrient watershed permit, which puts limits on the quantity of nutrients that can be discharged to San Francisco Bay. And these two events sort of renewed interest in all the parties working together on a long-term arrangement for supply. So this is a map showing the various service areas for Central San, EBMUD, and DSRSD. There's a lot of hatching, there's a lot of colors, but the takeaway is that our service areas and our facilities are in close proximity. And this is really one of the drivers for doing something at a regional scale. We also, in some areas, share a customer base. For example, for Doherty Valley, DSRSD provides water service to this area, and Central San provides wastewater service area. So again, a lot of opportunities to collaborate. The temporary diversion facility, as I mentioned, we executed an agreement in 2019 to construct this facility. It was completed in 2021. The agreement allowed for 5 years of operations, which expired in January of 2026. The agreement very specifically stated that the agreement could not be extended beyond 2026. This was to ensure at the time that it was a temporary arrangement. It requires that any use by DERWA beyond January 2026 requires a brand new agreement. And the intent of the parties when we started discussions last year was to have that long-term agreement in place before the temporary agreement expired. As I mentioned, we did operate this facility in 2021. We diverted approximately 0.7 million gallons per day from Central San to DSRSD's collection system. These photos right here are the diversion structure. It's fairly simple. This is DSRSD's manhole. This is Central San's manhole, which was converted to the diversion facility. It's just 2 slide gates under normal operations. The gate to DSRSD's collection system is closed. Flow goes up to Central San Ramon pump station where it's pumped to their wastewater treatment plant. And then if we do need a source of supply, they close the gate to the pump station, open the gate to DSRSD's collection system, and it flows to our system. So pretty simple. So based on the success of the temporary facility and the interest in a long-term partnership, in late 2024, early 2025, we began discussions on a long-term agreement. Some of the concepts being discussed, a 50-year term, converting that temporary facility to a permanent facility, which would provide a base quantity of about 0.7 MGD, a future option to expand the diversion facility and increase the quantity by 2 MGD for a total of 2.7. And 2.7 is the estimated total flow to the San Ramon pump station. So we were looking at amounts that would essentially divert the whole amount into the DERWA system. That ability to exercise the option was contingent on completion of technical studies that would look at what improvements were needed to expand the diversion and also potential impacts on Central San and DSRSD's collection and systems and wastewater treatment plant. Along the way, we were negotiating provisions related to roles, responsibilities, and allocation of cost and risk. And through these discussions, we realized that we were not going to be able to negotiate a long-term agreement that met the needs of all the parties without first answering some questions through these technical studies. All of the agencies, we have specific interests for EBMUD. They are looking for long-term certainty, an agreement long enough to justify investing in additional facilities they need to construct to reach other areas of San Ramon and Danville. They have to construct 8 miles of pipeline and 2 pump stations. For Central San, they are concerned and have questions on potential impacts to their collection system from diverting that entire flow during certain periods of time to DSRSD, as well as they've been pretty clear from the beginning that they have an interest in seeing that wastewater put to beneficial use. Their concern is that they enter into a 50-year agreement and DERWA never needs the supply. And then for DSRSD, we have questions on potential impacts to our collection system and our treatment plant. We definitely, or we feel reasonably confident that our facilities can handle the flow, but what's less certain is the impact of the additional solids on our wastewater treatment plant from this supply. So with that in mind, and actually I wanted to just highlight real quick some of these questions and why they're coming up. This is a graph showing DERWA recycled water production from 2021 to 2025. These are the years, and then this darker purple line is the 2025 irrigation season. And in 2021, as I mentioned, this was the 1 year that we operated the Central Sand facility. And you can see that irrigation demands were rapidly increasing that year because it was a very dry spring. We turned it on in June, and under the current arrangement, we can only turn the diversion on and off once per year. And that was an arrangement, an agreement with Central Sand because they were concerned about changes in flows to their pump station. But what this means is that you can see there was quite a drop-off in recycled water demand between July and August. We left the diversion on until September, not knowing if there would be another, week of hot weather. And in 2021, it was additional costs that went out through the LAVMA system of San Francisco Bay. But now with the nutrient permit, our concern is that this additional flow in nutrients would be counted against us when we're trying to comply with that nutrient permit. So one of the questions for DSRSD is we need to match up supply and demand if we're going to take this additional flow. So with that in mind, we pivoted to this memorandum of agreement. Some of the provisions include it's a term of 1 year that it can be extended for 2 additional years. And the structure of sort of going year by year was deliberate on behalf of Central Sand. They want to keep some pressure on the parties to complete these studies and negotiations on the long-term agreement. There's roles and responsibilities for completing the technical studies, a DERWA funding commitment of $300,000, which I believe the DERWA board approved last night. There's some good faith schedule milestones. We're looking to complete the studies by the end of the year and then resume negotiations and complete the long-term agreement within 12 months of completion of the technical studies. And then during the term of the memorandum of agreement, DERWA would be allowed to use those existing diversion facilities if we need them. So just a little bit more on the technical studies. There's kind of 3 buckets. The supply and demand analysis, we're updating those. You can see that demands have changed quite a bit. At first, we thought it was related to the last drought, but we can see now that there's some changes in customer behaviors that we want to capture. Central Sand Study is looking at the potential improvements that would be needed to expand their facilities. And then DSRSD's technical studies will be looking at impacts to our facilities. So next steps would be to finalize and execute the memorandum of agreement. EBMUD brought this to their committee in January, which is what they need, the authorization they need to execute the MOA. My understanding is the DERWA board approved or authorized the authority manager to execute the MOA at last evening's board meeting, and DSRSD staff were asking for a similar action from the DSRSD board this evening. After that, Central Sand will run through their process. We expect to execute the MOA in March and quickly move into the technical studies, which we still are on track to complete by the end of the year. And with that, staff's available to answer any questions.
Thank you very much. Any public comment? See no public, any cards, anything to worry about?
No speaker cards.
Let's go ahead and go. I went right to left. Last time, let's go left to right. Georgine?
I don't have any questions, but I wish we'd had this presentation last night because it sort of was sparse. Dinesh can agree or disagree as he might, but I better understand the purpose now. I was a little frustrated last night with all the timing and all the time that it's taken to get to this point, and so this is great. Thank you. I don't have any questions now.
Awesome. Did I?
Yeah, no other questions.
Ed?
No questions, just an observation. You're right, Georgine. I was on the board at that time when this first started out, and I'm amazed that it's 6 years later, we still are
Fighting over effluent.
temporary. No, I think it's a good presentation, and that sounds good. I'm ready to go.
Mr. Goel?
Thank you for the presentation. I do agree with those technical studies and the merits of that to make sure we're making informed choices. I even like even more the fact that they're keeping the heat and pedal to the metal. That way nobody stalls out. So thank you for running that through.
Well done. And you brought it up. So my only concern is sequencing. I don't want to take effluent until there's a place for it to go, because otherwise we're getting the hit for the nutrients. So as long as whatever the final agreement ends up being, that there's a definitive, our partners East Bay Mud need to take the effluent before, they need to, we need a very firm commitment there, and you know that. All right. I think actually we need to approve this one. I asked for comment, Doug. There was none. All right. How about a motion to approve item 8C, please?
Put them, and I'll second.
Got a motion and a second. All in favor?
Aye.
Aye. Yeah, we got another 5-0. That's a surprise. All right. Oh, now I got to read. All right, 8D. Approve amendment number 2 to the agreement for personal services between General Manager Shu Jan R. Lee and Dublin Sanitary Services District. Before discussing this agenda item, California Government Code Section 59453C3 requires the board to orally report a summary of the recommendation for final action on the salary and other compensation of a local agency executive, such as the general manager. The recommendation is also summarized in the staff report for agenda item 8D, with further details in the attached proposed amendment number 2 to the agreement for personal services. As is specified in the staff report, the recommendation is to adjust the general manager's salary by 2%, a cost of living adjustment of $6,744 annually. The total increase of the general manager's base salary after the COLA adjustment is applied is a new annual base salary of $343,920, which will be effective February 4th, 2026. Is there a staff report? I don't think we need one here. No staff report.
Well, I'll go ahead and just mention that all the other details you just covered 90% of what it is. The only other
did I miss one?
The only other detail isn't one that has to be recited verbally under the government code section that you cited to. The agreement will be extended for a 3-year period, so we'll have a full 3 years of the contract starting with this amendment.
Thank you very much for that clarification. Any public comment? No public, no cards.
No comments
All
received.
right. Do I have a motion? Oh, discussion. Anybody want to discuss? No. I don't see it. All right. I need a motion.
I'll put a motion forward to.
I'll second.
Okay.
Oh,
I was just going to say it probably should be noted that we did perform all of the review process before we decided on this amount.
Very good. Thank you for getting that into the record. I do have a motion in a second and a comment.
I was just reciting the recommendation, and I gave way to my director, who needed to interject with a comment that was worthy.
All right. Here you go. Can we call the vote?
Yes.
All right. All in favor?
Aye.
Any opposed? None. 5-0. No abstentions. All right. I have an 8E. adopt pay schedule in accordance with California Code of Regulations, Title II, Section 570.5, one of my favorites. Requirement for a publicly available pay schedule and rescind resolution number 4525. From staff on this one, please.
Good evening, President Halkett, members of the board. The item before the board this evening is to adopt the publicly available pay schedule in accordance with the California Code of Regulations. These regulations require that the district have a publicly available pay schedule that lists the current base salary rates for all classifications. The updated pay schedule before the board this evening includes the updated salary for the general manager approved by the board in the immediately preceding item. Staff is available should the board have any questions.
Thank you very much. Pretty pro forma. I'm assuming no questions. Entertain a move. Oh,
I do have a question. I guess because of some activity that we have, I guess even in closed sessions regarding to any other situations on any of these classifications, are we all set to be able to do this?
You are. If there are other changes, let's say to other bargaining groups, you do have a closed session for labor negotiations. Any changes that would be effective for any of those positions, you would have the same item come back.
Okay.
It's a very good practice to, whenever you make a change to any of those, to bring the whole thing back, because it makes sure that people, when they retire, have the accurate salaries documented. And CalPERS requires it. So
Okay, so basically taking this action does not set us in some sort of inconsistency.
It's only covering what has been authorized by the board or salaries that are in effect today.
Perfect. That's what I wanted to hear.
Yeah, we do this about 6 times a year. I mean, every time anybody gets adjusted.
Well, and it's just because there's a little bit of a sequencing thing that I didn't understand.
No worries.
Thank you.
All right. Do I have a motion?
I'll move.
And I'll second.
I have a motion and a second. Do I have some affirmative votes? All in favor?
Aye.
Aye. Any opposed? All right. There we go. Rip it. Pay schedule's done. Doug, am I okay to go to 9 at this point?
I think we are.
All right. Board member items. Joint Powers Authority. I know we had one. We talked about it a few minutes ago. What happened at DERWA?
All right. So, you want to go, Georgine, or you want me to get to it?
You go ahead.
All right. So, I think Georgine kind of started to discuss it earlier, but well, first of all, we finalized or approved the new chair for DERWA, which is the director sitting to my left here. So Georgine, congratulations for you. Was appointed as the chair, and then Luis Gomez was appointed as the vice chair. We also talked about, which Jan spoke about today, we did authorize the authority manager to finalize and execute the MOA with Central Stand to cooperate on the development of a long-term seasonal wastewater diversion agreement. So that was one thing that was discussed. And then the second thing was we authorized the authority manager to finalize and execute the agreement with CDM Smith for Central Contra Costa Sanitary District Evaluation Technical Study. So actually, there's 3 parts of the technical study. There's the Central Stand Evaluation, that's through CDM Smith, and that was in the realm of around $226,000. Then there's the study for the DSRSD collection system evaluation, and that's by Woodward and Curran. That's $18,000. And then there's the DSRSD wastewater treatment evaluation, and that's with Brown and Caldwell for another $72,000. And those were the items that that we covered yesterday. I don't know if Dr. Leopold has anything else.
I don't have anything else. That's the 2 items that were on our agenda
All right.
that we approved.
Well summarized. Thank you very much. All right, we'll go to 9A2 then. Submittal of written reports for day of service events attended by directors. Written reports to do this evening. Does anyone have any reports of service? I'll start on my left.
I attended the January 21st meeting of the Alameda County Special Districts Association at CB San. The presentation for the day was from Ora Loma. Unfortunately, I set my alarm for 7:30 instead of 6:30, so I missed about 15 minutes of Oraloma's presentation. But it appeared that everybody was really engaged in it. So, and then the second presentation was from ACI, Alameda County Industries Chief Operations Officer, about the plastic pollution issue. And then we had a short update on LAFCO. We had a short update on East Bay EDA chapter representative. Colleen made a presentation regarding the issue with emergency vehicles, the fact that the state either is or has, which I didn't totally catch, in the process of changing the fact that emergency vehicles aren't going to be required to be EV, simply because it just doesn't make statistical, that's wrong. No, doesn't make sense because of how they might be called out and when they might be called out and all the other things. And, if you're stuck on a freeway doing some emergency, where are you going to plug in to recharge the car? So, like I said, I didn't understand from her if it had been done or was being done. But we talked about this last year, the fact that emergency vehicles was stupid to be included in the original date for making everything electric vehicles. We approved the minutes. I gave a financial report. Ironically, there was only two people who hadn't paid, two organizations that hadn't paid their dues. One was East Bay Regional Parks, and the other was the Resource Conservation District. Well, the Resource Conservation District has now paid. And from what I understand, I haven't seen any of the paperwork. From what I understand, East Bay Regional Parks paid very quickly also. The only other thing is our annual dinner on March 19th. Make sure you let Jan know if you want to go. They always put on an excellent dinner. And that's it.
Excellent. Thank you very much.
I just have one thing. Just completed my biannual ethics training on 127 and 3 days before it was due. So,
I do have a question. Do you have any idea when we're going to get the financial training? When that started?
We, at the next board meeting, I believe we're going to have an update on the new laws and some of the requirements. And we're also getting a training schedule out of CSDA to complete that requirement. But the existing board members or the seated board members have a little bit more time than new board members or the new finance director.
Okay. Thank you.
Just to put a little number on the extra time, it's in 2027.
Oh,
So
yes.
for those of you sitting here today, you have quite a bit of time.
Quite a bit of time, yes.
Mr. Duarte, Mr. Goel. I have nothing either. Anybody want to request any new agenda items? I'll start on my right. Nope, I'm seeing no shakes. No shakes. Okay, staff reports.
There are quite a few upcoming events, beginning with the State of the City for Dublin on February 24th. We are going to have exec put all of these dates and events in the GM Communications update that will go out this Friday. If you could please check and let us know if you have not signed up for which events you want to attend, because it does affect, for example, sometimes with the city events, we'll buy a table if we have enough board members and senior staff that want to attend. So the sooner you could let us know, the more it would be appreciated. Thank you. And the GM conference room for closed session this evening.
Excellent. We have 3 closed sessions. Mr. Cody, do I need to read all these titles, or can we just go for it?
You do not. There is the one additional attendee is already listed, so I think we are good to go with what's on the agenda.
Got it. GM conference room? Okay, everybody, if you can mute your mics, please. Okay. The meeting's back in open session. The closed session has concluded. There were no reportable action taken in closed session. I can't see that far. 8:22. We'll call this thing adjourned.
Thank you.
Thank you.